What I'm doing is I'm raising money to build a portfolio of established private companies. What I'm going over right now is the executive summary of the detail. I have detailed videos of what I'm summarizing for you now. And basically, the outline is the intro, risk and mitigating risk, my background, the model, 3 keys to success in the summary, and catching anything that I forgot to mention in the other categories. So let me just write that over here. Now this investment is for accredited investors, and the reason for that is because the SEC rules, even the new rules, want to make sure that if you're raising money for a fund and you're reaching out by general solicitation to investors, they must be accredited investors because it is a fund. And so anyway, it kind of restricts the who can invest in this. Okay, so anyway, I'm building a portfolio of established private companies, and there's a couple key words here. The portfolio, you're reducing firm-specific risk, building a portfolio of established companies, private companies. So, and usually that is in my first key to success under the 3 keys. I go into the anatomy of the target company, and what it has to have, and that tells you kind of what established means. And really, quite simply, established is cash flow at least 20% of revenue. For a upstart company to have cash flow at 20% of revenue, it's very rare. But for an established company to have that on average, 3 or 5 year average, going back to historical cash flows, it's not uncommon, and certainly that's a floor. So there are companies out there that have better than that, and they are for sale. But so I go over in the first key to success the anatomy and the type of company, and how how much I'm going to pay for it, which is very important. The cash flow, and how much the purchase price is. Now this is similar to Warren Buffett. Warren Buffett, Berkshire Hathaway, has really 2 main portfolios. The privately held company portfolio, where he buys 100% of these companies and owns them under the Berkshire Hathaway investment vehicle. And the other are privately held or publicly traded security stocks. So he has about, I would say, about 40 to 50 of publicly traded stock in his publicly traded portfolio, and about 60 to 65 private companies, established companies, in his private company portfolio. And that's where I believe the big value is, because if you're an accredited investor and you made your money from a company that's been in your family, or one that you started, the power of companies and how much that activity can create for wealth. And it is the best investment out there that can generate the most income for anybody's time, for your time. It's the best investment for your time that can generate the highest returns. The sky is not the limit. The owner is. The owner of these companies are. So that's what this fund is. It's buying established private companies. Now I'm raising $5 million to get this started. $5 million net of any fees and transaction costs. The name of my fund is called MCHO Custody, and I'm Steve Bagnashi. Now, MCHO Custody, EC for short, that's the abbreviation I'll use throughout my presentations. It simply means to purchase and hold, and that's exactly what this fund is for. It's not going to buy and sell like typical private equity funds. It's going to be more or less like Berkshire Hathaway's private company portfolio, buying established companies. Now I'm raising $5 million to get this started. This is a long-term investment. It's not a get rich quick scheme. It's $5 million and the fund is closed after that. No other investors can come in unless you want to monetize and sell your share, your investment, which I'll go over in risk, and it's not a readily tradable security, but it will be of a significant size by year 15 to the point of 3.2 billion in revenue. And I'm going to get it started with 5 million. I'm going to show you how this is going to progress. But okay, so 5 million net of fees and transaction costs. Those fees and transaction costs are only created if there are brokers that bring you to this investment opportunity. Those are the fees and transaction costs I'm talking about. And some platforms on the internet, like GoFundMe, they will charge fees and transaction costs with raising money on their platform. So that's all what that means, net of fees and transaction costs. 5 million is what I want to start with. Excuse me. So let me write some of this out. Now, what you get in return, you get 80% of MCHO custody and held as a limited partnership interest. And with the changes to the new tax law, or the changes caused by the new tax law, I believe that is 99% the best vehicle, unless I'm missing something, but that will certainly be looked at. But held as limited partnership interest, and you get 80% MCHO custody. Okay, so to give you comfort that when you write the check, that money is going to be used for the purpose of what I'm saying it's going to be used for. It's going to go into an escrow account. And that escrow agent is going to have 4 basic instructions. The first is to pay any fees and transaction costs associated with raising that money that wasn't already deducted prior to writing the check. I don't see that as a in the rare circumstances. So that's the first. The second instruction is for $30,000 that will be set aside for a private placement memorandum or partnership agreement / both. And really, the partnership agreement is going to cover what I'm talking about here. It's going to cover everything, and then of course any legalities that go along in with that partnership agreement for your review, obviously. But it's going to cover exactly the stuff I'm talking about here. No more, no less. The third instruction is up to $150,000 for a due diligence. So that will be carved out of that $5 million investment, up to $150,000 for a due diligence on the first company that identified to purchase and put into this portfolio in MCHO custody. And that should cover any, obviously if the third parties that go in there and myself and find out that there's something that just can't be, where it doesn't make the purchase or wouldn't make it a good purchase, and to stop the due diligence, and we already incurred fees and costs, that should cover that in that rare circumstance. But prior to getting there, prior to getting to the due diligence, that company is going to be vetted out. And I'm going to be doing the vetting. But prior to getting to that and getting third parties in there, where the work is going to start and proofing out the, making sure it's a good purchase. So I have set aside $150,000 in that escrow account for that purpose. The last instruction that escrow agent will have is the remainder that's in that account. So say about 4.9 million or 4,875,000, whatever the remainder is, that will be used to write the check, to close the account, and go to the seller when the company is purchased. And that happens at the closing table. And the people at the closing table will be myself and MCHO Custody's attorney, as well as the seller, their attorneys and representatives, and the senior lender that is going to be in there providing the majority of the purchase price. They'll be in there as well. And as soon as that purchase agreement is signed, that's when the escrow agent will transfer the money to the seller. None of this goes through me. It goes right from the escrow account to the seller's account, and the account is closed. Before any checks are written on the due diligence or anything that comes out of that account, the escrow agent has to make sure that the work is has been done, and it's evidenced by the work, and it's signed off by me, and the invoices are are approved by me. But they have the backing of that work that was done. So that's what they are going to make sure that happens, and they're to unrelated third parties. So that's what the escrow agent's instructions will be. So those are the 4 basic instructions. The account is closed after that. Okay, so what you get in return. Now, again, I alluded to the fact that this will be a pretty significant size, which also brings risk along with it in getting it to that size over that time period. But in year 15, it will be a pretty significant size. So there's 2 ways to monetize your investment. One would be a private exit, selling to private investors, other accredited investors, family offices, and even institutional investors. And it would be of a significant size to attract some of those institutional investors. The other is a public exit, which we're going to have a vote in year 15. So there's 2 ways to exit this. Okay, so before I get to the private exit, what makes this investing in privately held companies beneficial to you as investors is that in year 11, I'm going to start making cash distributions equal to, at the very least, to your investment, what you invested in. So the gross investment, after fees and transaction costs, it's going to be before that, the gross investment. I will make cash distributions starting in year 11 and continue them every other year from year 11, at least equal to your original investment. That's the benefit of owning these, and it will continue. And if we decide not to take it public, you'll have 80% of the vote, I'll have 20% of the vote. But if we decide not to take it public, these cash distributions will continue, and that's the benefit, and get greater, depending on the success of the portfolio. But if it's as successful as what I'm modeling and proposing to you, then it will have potentially significant cash distributions. So that's just kind of what I said, cash distributions beginning in year 11, and every other year from year 11, at least equal to your original investment. So in year 10, it's going to be a significant size. In year 15, it will be even bigger. So in year 10, it will be about 600 million in revenue, about 570 million in revenue. And that will attract investors. But by year 15, it will be 3.2 billion in revenue. And the way I get that from a $5 million company is that, now I go over it in risk as well and the model, but the $5 million investment, your $5 million investment will buy a $25 million company. And, I'm using a 5-time multiple of cash flow. So that produces about $5 million a year in cash flow, and about a 25 million revenue company, give or take a few million. Obviously, if I buy it less than a 5-time multiple, and I go over that in the first key to success, then it's a better purchase, and the cash flow to revenue is greater. But anyway, so that first purchase, be a 25 million revenue company, it will be kicking off at the very least 5 million in cash flow. The net cash flow that company produces, so after the principal and interest is paid from that cash flow, to pay the acquisition debt, that after that is deducted, it's net cash flow. That net cash flow will be used to buy the second company. Those 2 companies' net cash flow will be used to buy the third, and the 3 companies in the portfolio, their net cash flow will be used to buy the fourth, and so on and so forth. And as the time progresses and the cash flow, the net cash flow gets larger, the potential companies get greater, and or the number of companies that I buy and put in the portfolio get greater. But I'm looking at nano to micro cap companies. At first, nano, under 30 million, but micro cap, so nano to micro cap, about 10 to 300 million in revenue companies. That's what I'm looking to put in this portfolio. And, in the type of companies that I'm looking, we'll go over in a little bit, but, or at least to start the portfolio. Now, in a private exit, the value increases up to 73 times. Excuse me, if you hear that, we have a 180-pound bull mastiff. He just came down into the basement, my makeshift studio here. But you'll hear all kinds of air coming out of him, and it's not me to hear breathing, snorting, and all kinds of air comes out of him. So that's him, and you'll hear him in the background. So private exit up to 73 times, and I go over that in the value section, how I got to that, and it's in summary of that, and the value, to make it real quick, is the value of the companies that I put into the portfolio. The total portfolio will be valued the same way, even though you can argue that it's a bigger portfolio now and there's more companies in it, it's stronger, so an investor would pay more for it. That's what we would have to negotiate with when you want to sell your interest, should you want to exit in a private exit. But that is, in summary, how I'm valuing that. So it's pretty conservative because I'm valuing it based on a 5-time multiple of cash flow, less the acquisition debt. The public exit is a multiple of cash flow, but a greater multiple. And that's where I believe the arbitrage is between a private and a public exit. A public shareholder would value your investment more than what a private shareholder would. So I believe there's up to a 469-time increase in your investment should we want to exit in year 15. But I would like the right of first refusal on the private exit. If you want to exit, I would like the right to either meet or beat an investor that you want to sell to should you want to exit. But the fund, I'm looking for long-term investors and not get rich quick, just long-term and steady. And that's where I believe this will start extracting value for you and providing value for your future generations and kicking off cash distributions. The optimal thing for me would be you to stay in it, and you want these cash distributions every other year, kicking off indefinitely. And that's what this MSHO Custodia is. It's a fund to hold companies indefinitely. So that's where we're at on the exit and return. And of course, I go into more detail than I have here. Okay, so that's the intro. Again, this is executive summary, so I'm going to kind of fly through this, but I do have videos up there that are detailed, and of course you can reach out to me anytime and ask questions and discuss this, and what did I mean by saying this, or what did I mean by saying that, so I know there's going to be a few interpretations of what I meant. And of course I make probably some verbal blunders during my speech. I can't tell you how many takes I've done with this, and this is probably my 1,000 take or 1,200th take on doing these videos. Okay, so the risk. Now, this is a very risky venture. Of course, it's using the entire net cash flow of the company to buy the next company. It's using the entire net cash flow of those two companies by the third, and the entire net cash flow of 3 companies. And that's what it will do until year 11, and through year 15, just short of any cash distributions. But it's going to use that entire net cash flow to buy the next company. That makes it pretty risky. But one thing that, well, I don't want to go over that now. It's mitigating risk, but that makes that risky. And of course, my background also is risky. When you invest your money, you're investing in the person. If it's not you that's doing it, you're investing in somebody else, and that's always a risk. So I go over that in my background. I have out of the box type of experience, and So I'll go over that shortly. The other risk is that this is not readily tradable. So you can't turn around and try and sell this on a stock exchange or to another investor quickly. It's not readily tradable. We have to look for investors. We have to look for an exit. And if it's sooner than if it's sooner than 10 years or 15 years, it might be not a hard sell, but it might take a little bit of time to find somebody to take out your investment and value it where it's a substantial return for you. Okay, so it's aggressive, not readily tradable. You can lose your entire investment. And compared to other investments like government securities and index funds like the S&P 500 or the Vanguard 500, very risky. Compared to Berkshire Hathaway, very risky. Compared to mutual funds, very risky. But compared to private equity, hedge funds, and owning your own business, not as risky. What I want to add under risk, and I forgot to briefly talk about this, was your investment choices. Your typical asset classes where you could invest in. And I'm going to rank them by return and, really by return and not so much less risk, but by return. So the first one is Berkshire Hathaway. The compound annual growth rate since 1965 is about 21%. That means your money doubles every 3.5 years. So I'm just going to go ahead on the board here and write some of those rank according to the compound annual growth rate, those asset classes. So the first one, like I mentioned, Berkshire Hathaway, compound annual growth rate is 21%. Money doubles every 3.5 years. Okay, so apartment units, the compound annual growth rate is about 15%. If you own them and you invest in apartment units, you can probably do that calc yourself and see what your return has been. But that doubles about every 5 years. That's a very safe investment. The next is index funds, such as like a Vanguard 500 or the S&P 500, where they're broad index funds. So they're not just an index fund investing or assembling a portfolio of growth companies. It's a broad index fund, and the Vanguard 500, according to their website, has 10.96% return, and your money doubles about every 7 years with that since inception. I think that started by Bogle in 1975. The next is the S&P 500. Now that's 9.7%, and your money doubles about 7.5 years. And I got that from really Berkshire Hathaway's annual report, and he compares what his company has done or Berkshire has done compared to the S&P 500. The next is PE and hedge firms. Now this is where a lot of controversy is raised, and there's not a lot of information out there, but there are studies done, and I have those by professors that have studied the industry, and after fees, so they outperform the S&P 500, but after fees they underperform. Now, more or less the PE firms, that's where the research that I have, and there's not a lot of data out there because they're not they don't tell you what their actual numbers are, but they're at about a 6% compound annual growth rate, and that doubles your money every 12.5 years. After PE firms, I have T-bonds, T-bills. T-bonds about 5.5%, T-bills about 3.7%, and the money doubles 13 years and then 20 years for T-bills. And then inflation at the bottom here, about 3% inflation, and inflation doubles every 24 years. mitigate risk. So I'm buying established companies and building a portfolio of established companies. So the portfolio protects against firm-specific risk. Getting established companies are not; these are not startups, and they're not gonna take cash and bleed cash in order to generate revenue and have have negative cash flow. That's not this. These are established companies, and I'm looking to buy companies with at least 20% cash flow to revenue, and the purchase price is not going to be more than 5 times that cash flow. And they're out there. They're out there every day, every year. Not every day, but every year there are multiple companies that are out there that have these variables that I'm looking for, and or I guess that meet the criteria that I'm looking for. Whether I'm successful at negotiating them is another story, but they're out there, and they're even better. Some have 30% cash flow to revenue, so they're out there. But I'm buying established companies, and I want to buy one a year. So again, I'm using the net cash flow to do it, so that's the risky part. But buying established companies mitigates that risk, along with building a portfolio of established companies. And, okay, so I have to put up here my background as a risk. And then down here, I also put it as mitigating risk. I've actually done this. I tried to do this, but I bought companies, and I failed at it. And for reasons I understand why I failed, it was very risky the way I got into this. I didn't go in with investor money. I went in with 100% borrowed money and paid a lot for my first company because I wasn't going to get another chance, and there was no way I was going to be able to raise money without having any experience. I tried, and I never managed anybody, and nor did I cut my teeth managing a company, and then got to the point where I had a lot of money to invest and buy a private company. I didn't do it that way. I went and looked for a company, found a bank, and they lent a lot of half the purchase price, which was a 15-time multiple of cash flow. They lent half of that, and the seller had to take back the other half because it was such a large, at 15 times cash flow. It was such a large purchase, but I jumped on it, and I cut my teeth. And for reasons of the second and third key to success, which will make this fund and every company in this fund very successful, I learned something that I didn't anticipate prior to buying or wanting to buy companies and buying my first company. I realized something when I bought it, and it didn't. I never anticipated it. I never read about it, and I do a lot of reading, a lot of business books. So anyway, so my background is by experience and out of the box from other money managers. Now, the other part, and this is the last thing I'm going to say about it, I apologize, but the other part of this is that you should have obviously you manage your money very well. That's why you have it. And not a lot should go into these type of investments. MCHO, custody, private equity, hedge funds, not a lot. And because they're risky, they haven't proven the return that the index funds have. So the S&P 500 and the Vanguard both have beaten private equity and hedge funds. The only ones that that can beat that, well known, are Berkshire Hathaway. Of course, if you made your money owning a company or companies, or it's in your family, you know that you made more money than any private equity, hedge, or index fund can make you. So an index fund, let's say the Vanguard 500, will double your money every 6.5 to 7 years. The Berkshire Hathaway will double your money every 3.5 years, and that's a very safe investment. And I say as safe as index funds and or the government. I mean, when there's something wrong with index funds or a portfolio like Berkshire Hathaway has, then there's probably something inherently wrong with the economics of our country. But dare I say that they are on par as far as risk. But so those are three investment vehicles, two, index funds, the S&P and Berkshire Hathaway, that, the majority of everybody's money should be in there, whether it's a pension fund or an endowment fund, or your own money should be in those two asset classes or choices. This is another choice, and I believe this is better than private equity because they try and flip them in 5 to 12 years, and they don't do that well as what they think they do. There's a lot of research now, and the data is out there. And I have a very good PowerPoint that kind of is more or less a pitch book and goes through all the investments and the investment choices. So it goes over private equity, hedge, index, Berkshire Hathaway, and it's pretty enlightening. Oh yeah, the other piece as far as investments are real estate, apartment units. That's another great, it's more active, not passive like these are, but more active. But to me, that's probably the best way to park a lot of the money that you earn. If you monetize those index funds, if you monetize Berkshire's securities or anything investment that you monetize and you have a lot of money, I would look to get into apartment units. They are great returns, solid return, and if you ever have to monetize, you can always sell those properties. They are always available for sale, and any clean property in great condition or good condition sells fast, and that's why they're good investments. But other than that, so that's all I wanted to say on asset classes and parsing out your investments across many different options. Okay, one thing I forgot to add under mitigating risk, and that is transparency. And a part of transparency is salary, my salary. What I'm going to get paid is $250,000 a year, and that's a salary, and that's paid by those companies in the fund. That will increase by $50,000 starting with the second acquisition and each acquisition thereafter, but it's going to be capped at $500,000. So my salary is going to have a cap at $500,000. Okay, so there it is. My salary, $250K a year plus $50K per acquisition, starting with the second acquisition, capped at $500K. And that also works good with the cash distributions because it gives me an incentive. I certainly want to make more money, and getting that from cash distributions when I take out a dollar, every dollar has to be split 80-20. Obviously that in excess of my salary. So anything outside of my salary that's taken out of the company has to be split 80-20, and that's cash distributions. But this is also transparency, and part of this is the salary, and the other part is audits. Audits will happen annually, or they can happen quarterly or semi-annually, depending on you as investors and what you want to see. But a part of that, those audits, and part of what they do in audits, internal controls, they'll be auditing my salary to make sure that I'm not taking anything out of the company that I am telling you here. They're going to be auditing my salary and putting that up, but they're also going to be auditing meals and entertainment and any travel expenses, anything that was used by me. But outside of travel for these companies and doing the due diligence outside of that, that will be up there as well. And so you will see that, and it'll have explanation. This is what it was used for, and this is what I did, why I traveled. That detail will be there, and what it's meant to scrutinize is make sure I'm not going outside of travel that I use for business and bringing my family along, or going on personal trips and vacations, or whatever the case may be. So that will be there for investors, for you to see, for you to scrutinize. The other piece of transparency is all this stuff will be in a password protected website with, only investors will have access to this. So only you as an investor group, as investors, will have access to it. And what you'll see on that on the website are very detailed information. So the companies I'm looking at, short of the company and the phone numbers, so that nobody will call up and scare the company, and the employees get wind that hey, there's somebody going to buy us, I'm starting to look for another job. Just short of that information, but all that stuff will be there. The initial offer, what I'm going to offer, and the data to support that offer. The historical financials, the average EBITDA or average cash flow, and how I'm looking to finance it, and how that's going to break up and get to net cash flow. So that will be there. And when they're acquired, let's say in year 10, there's 10 companies in the portfolio. You will see each 10 in a column, and they'll all have the same general categories, but you will see the same categories along each row, and then for each company, and then it'll be consolidated for the fund for you to see. And then at the bottom, of course, I'll get to cash flow and net cash flow. But all that information will be there. The purchase agreements of the ones that were purchased, the offer letters, the initial offer letters, the final offer, whether they're accepted or not, the result of the due diligence. And then, of course, when these companies are reporting every month end, you'll see this information. All that financial information will be updated by hopefully the 5th business day after the month end, the 5th or 6th business day, and it'll be updated by the controllers or the CFOs at these companies. Will put the information up there in that format. So that's transparency, and it'll be as transparent as if it was your own company. The only thing that you will not see up there will be employee information, supplier detail, and customer detail. And that's really to protect the fund, because you don't want somebody to take advantage of that information at the detriment of your investment, at the detriment of the fund. So that won't be up there, but it'll be up there in totals for that, for those specific categories. So the website will have all this information, everything on there for you to see and access it at any time. Now, I will do month-end reviews, and I'll go into more detail on quarterly reviews. And at these quarterly reviews or monthly reviews, there'll be a WebEx. And certainly I'm available by phone, email, at 24/7. I might not respond 24/7. I'll respond, if it's in the middle of the night, I'll respond when I wake up. But 24/7 access to any information and this information. Then I'll do WebEx's month-end reviews, and also quarterly reviews, go into more detail and kind of more strategic and see what's coming down the pike. And also here, obviously this is a collaborative investment. I'd also like to hear some issues that you think are coming, macro, microeconomic issues, how, if we're, some of these law changes to be, as a recent example, how that might impact decisions and going forward. So that is certainly great discussions to have at the month end and at the quarterly. So I think that covers it in mitigating risk that I had to add that I left out. Also, the escrow account mitigates risk, and so does when I close the fund after the $5 million is raised. So after you invest $5 million, the fund is closed, and that's to protect against Ponzi schemes. So Bernie Madoff is the most popular, but there's a ton of them out there that have happened. And Ponzi scheme is that a current investors pay off the old investors, and it just keeps escalating that way. So this covers that and makes sure that the fund is closed after $5 million is raised. So anyway, that's mitigating risk.
Here's to the crazy ones, the misfits, the rebels, the troublemakers, the round pegs in the square holes, the ones who see things differently. They're not fond of rules, and they have no respect for the status quo. You can quote them, disagree with them, glorify or vilify them. About the only thing you can't do is ignore them, because they change things. They push the human race forward. While some may see them as the crazy ones, we see genius. Because the people who are crazy enough to think they can change the world are the ones who do.
Now, what I wrote up here, Ivy League, best and brightest, PE hedge fund experience, Wall Street, investment banker experience, net worth and relationships. That's not me. That's exactly in the box type of money manager experience that that has produced less than the S&P 500. So that's in the box. Now, this started with a thought at 10 years old, and I go into detail on what created that thought. It was wrong, but I was only 10 years old, and that's how I interpreted and started this passion. I didn't start pursuing it until about 2 years into the military. I had 2 years left. I was already in for 2 years. I saw friends of mine getting out, and they didn't know what they were going to do. And I didn't want to go through that. So really, I fell back on the only thing that, I don't know, that I wanted to do, I guess. I wanted to do something that I liked. And I started reading books. I leaned on my father to help me out with what books to read, not so much just to understand business. That was a great start, I thought. Harvard Business Review, The Economist, Foreign Affairs, which doesn't sound like a business publication, but it's economics. It's really macro and some microeconomics, but very great publication. Harvard Business Review, and of course, all these books that I've read and still read, and I read them constantly to this day. The Wall Street Journal, and I read to know. I read to understand and know things. And that's what really is what I'm all about. So I went to school after the military. I went to school for accounting, not because I wanted to be an accountant or liked accounting. I didn't. I went to school because I felt that accounting was the nuts and bolts to understand any organization. I wanted to understand where cash flow came from, what what deferred taxes meant, how they get to this net income, stuff that I couldn't teach myself. I felt a lot of this other stuff I could. I got Theodore Levitt's books on marketing and business development. I've read Warren Buffett books, but anyway, prior to Warren Buffett or knowing, or understanding who he was in the 90s, this was before. So I started reading a lot of books and articles in reading to understand. It took me a while to understand some of this stuff, and I would just read it until I understood it and get the reference books that I needed to understand it. So very self-taught. Now, I went to school, I went to Cal State Fullerton, and I had a 2.89 GPA in accounting. And that was very indicative of my understanding of accounting. I did not understand it, and I wanted to understand it. So with that GPA, I wasn't getting into any big five accounting firm at that time, public accounting firm. There was big five at that time. I had a network to get in. It took me a year to find somebody who knew somebody who got me in Arthur Andersen. And from there, my learning went up. It was slow. I was like a sponge. I wanted to learn stuff, but I really liked one part of public accounting, like merger and acquisitions, that I learned from that how accounting works and how, to record for, what GAAP, what that means for the books and records of a company, and how to get from GAAP to tax. So I understood that through really that passion to understand mergers and acquisitions. So, and I'm not saying that I worked on a lot of M&A stuff. I didn't, but that was my vehicle, and Arthur Andersen had all that information at that was available to me, and I took advantage of it. I read. There's one book that it's a big book, and it's over 1,000 pages. I read it 3 times, but half of that book is on the research and the backup that went into writing that book. But the Ginsberg and Levin novels, the structuring venture capital and entrepreneurial transactions, I read that book 3 times, and I understand it, and I understand it now to this day. And it opens up to understand their M&A volumes. Anyway, that was at how I learned accounting, and I learned it real well, which paid dividends, I feel, when I wanted to buy a company. So that was my GPA. Now, I bought 3 companies, and I wanted to build a portfolio. My idea was the first company that I bought, the plan was I paid 15 times cash flow for it. I would find a company much easier and at a better multiple to bring the total multiples of those 2 purchases down to around a 5-time, or look toward a 5-time multiple, maybe get it to an 8-time multiple. But the next company was going to be bigger and have better cash flow and pay less for it, pay a 5-time multiple. Combining the 2 would bring it down to hopefully an 8-time multiple of the 2 companies and keep buying. I felt it would be easier once I had a company. And it kind of was. However, I wasn't successful in buying that next company. I failed at it. But I did discover something that even at 15 times cash flow, the company turned around. It had to turn around, and it did. And in the second and third key to success, the reasons for that I didn't understand prior to getting into it, and I'm glad I did, just for that understanding, that I wouldn't have known otherwise. My second company I had to purchase, the company was growing so fast, the first one. The second company was a competitor. Excuse me. And so I had to buy it to meet the demand. I had increased capacity to meet the demand. And then the third company was a horizontal purchase within the same industry. But and then it failed. So in about the fifth year in doing this, there was a new bank that bought out the old bank, and they canceled my line of credit. The new bank did, and I couldn't find a replacement line. And this was at the base of the Great Recession, and the banks, at least around here, and I reached out to banks all over the country as well. They wanted net worth to cash flow, or net worth to what I was going to borrow on the line. So after 7 years, it grew very fast, but I had to liquidate, and that's a whole entire learning process as well. So this, I just have to put it up here. I love business. I have a passion for business, and I read it every day. And it takes me a long time to get through an article. And maybe I'm a slow learner. I don't know. Maybe that indicates 2.89. But that's the way I read. I underline, I write stuff, and I come back and read it again and look at what I wrote to see if it made sense, and to look up that stuff that I made notes on, and just look up that stuff and go in on the internet and do some research and see if that if that's what that meant, or just to see how I understood it when I was reading it the first time. And it takes me a while to get through articles, any articles, Harvard Business Review, The Economist. I like it. I love reading, and I like reading it in digital format, so I could copy it to Word and make notes and stuff like that. But I go to know. I want to understand it. So I want to understand branding. I want to understand how a company did something, or in Harvard Business Review, if some of these professors are saying, and it makes sense to me, in my comments, so that's the way I do, and that's how I get involved in something. I read, I go for understanding and to know how things work. Now the model, again, the first $5 million, your investment is going to buy a $25 million company. That company will produce cash flow in the first year of $5 million. And that I go over in the first key to success, how that works. The anatomy of the target company, my principle and criteria for looking and buying a company, and how much I'm going to pay for it, all that factors in to that cash flow. And that net cash flow, that principal and interest, is subtracted from it on the acquisition debt. And that net cash flow is used to buy the second company. So the first company will be $25 million. The second company will be $10 million. It will be in the same region doing similar things. And I'm going to combine them. And I'm not going to lose jobs. No jobs are going to be lost. I'm going to increase capacity and combine the two companies. And the net cash flow from those two companies will buy the third, and in a different region. And that company, that third company, doesn't have to be doing the same thing. So the type of companies that I'm looking to buy at first are manufacturing companies. They have physical assets, and there's a lot of ways to structure financing with companies that have a lot of assets to finance. There's a lot of ways to break up that senior debt. Building materials, manufacturing, chemicals, machining, metals, plastics, manufacturing companies. And I believe that they're going to be regional. And there's reasons other than cheap labor for them not becoming regional, being manufactured in China, which now China, their labor is getting expensive. As they become a consumer-oriented country, they're going to start importing more and requiring more wages, like the U.S. and other developed countries. The wages get greater. And they're at that point already where it's not beneficial for it to pay shipping costs and waiting time and how much you have to buy in order to ship and get it here to make it make sense, to make that to have that order make sense, how much you have to order to get it over here, and that sort of thing. Those costs are making it very on par with the U.S. And I always believe, I go over in the third key to success, the value propositions a company provides its customers. Quality and service are at the top. And how much quality can you have and how much service can you have if you have your company over in China or it's producing in China for a U.S. consumer? Now, I understand having companies in the region where their customers are, and that's what I'm building here. I want manufacturing companies located close to the customer base and, of course, the supplier base. And a lot of the raw materials and the resources are in the regions that these companies are in anyway, or will be. But that's not to say that the companies won't expand to other countries and have the manufacturing footprint close to those customers. And I firmly believe I go over the four basic propositions that all customers value. You're a customer, I'm a customer, we all value them in different weights. And quality and service are at the top. And having that control on the quality and the service component is really manifests itself in a region where the customers are in the same region. And so shipping it over, I don't really necessarily believe in that. However, back in the day when all this was coming to, companies were looking overseas for better, cheaper production costs, that wasn't the only reason. There was other reasons. One other main factor, which I'm not going to go into, I'll definitely, talk to you about it personally. But there was other reasons. One main reason why companies left the country and produced overseas. Okay, so back to my model. That $5 million original investment will buy a $25 million company. That net cash flow that company kicks off will buy the second company. That net cash flow those two companies kick off will buy the third. Now, in every year I'm going to do the same. So that net cash flow is going to buy the next company to the point where it's $3.2 billion in year 15. $3.2 billion in revenue. The companies and the opportunities get greater as well. As that net cash flow grows, the opportunities grow, because now there's always big companies, global companies that are divesting of assets. And also when they acquire, they can't acquire, because of antitrust laws, they can't acquire all the assets. They have to let some go, and those opportunities present themselves. And of course, sometimes these big companies, they incubate, a smaller division, and when it gets to be a moneymaker, but not to the size where they think it would be beneficial to have it and hold it inside, they'll sell it. And one example is Johnson & Johnson. They're a big company. They incubate small divisions, and if they think they can get them to a size where it makes sense, then they will keep them. But if not, they'll sell them. And those companies are good companies. They just aren't going to grow to the size that these big companies want them, like J&J, a $70 billion company. But that's perfect for MCHO Custody, because what I'm buying is that cash flow as well. I mean, really, that cash flow is what I'm investing in, and that's what this fund is investing in, and the future production of that cash flow. That's why it's established companies. Okay, so that's the model. It's quite simply, and that's it. And then in the first key to success, I go over the anatomy of the target company and how this model builds on itself, and how much I'm looking to pay for those companies, and how I'm going to finance them. That all impacts the model. So just the common ones: metals, chemicals, plastics, building materials, packaging, other manufacturing companies that I didn't that aren't covered by these categories here. Then after that, I'd like to get into service companies. And the reason for that step process is that service companies, the cash flow is required, that the current cash flow needs to cover current operations is more substantial in service-oriented companies, because the labor is paid weekly and biweekly, in manufacturing as well. But they use the manufacturing, the machines, to leverage a lot of those human resources. So whereas service companies, it's 100% labor. So the type of service companies, after the company, the fund has enough cash flow to cover any short-term cash requirements for these service companies. The service companies that I have up here: IT, distribution and logistics, insurance companies like not insurance underwriting companies, the ones that are actually collecting the premiums and paying the claims. That's the type of insurance companies. Like Warren Buffett has Geico and General Re, I believe. So when it gets to a certain size, insurance companies would be a great addition to the portfolio. Not a lot. There's probably not a lot out there, but insurance companies would be a great addition because they have great cash flow. And as Warren Buffett alludes, or he discusses the float, he calls it a float, that cash flow. It's a great short-term buffer. And then, of course, retail. For discussions of the model and the companies, these are later, but distribution and logistics, IT, insurance, and then retail. But those are the type of companies that I'm going to put into the portfolio. So I think that covers it for the model. Okay, what I'm going to go over now are the 3 keys to success. What I'm doing is I'm going to summarize that for you. I'll provide the detail when you reach out to me and you're interested in investing in MCHO Custody, or at least learning more about MCHO Custody. Here comes our 180-pound bull mastiff again. So anyway, so I'll provide that detail. So I just want to summarize it here, the 3 keys to success. And the reason for that is I believe in it. I firmly believe in it. I know it works, and it can be used by others that are out there and that might have access to this or gain access to this video and presentation. It's very it can either apply to a company in a turnaround situation, or a company that is not in a turnaround situation but wants to grow and continue to grow. So anyway, I firmly believe in this, and it works. I've done it, and from my experience, and that's why I don't want to share it until I know you're interested in investing in MCHO Custody. The first key to success is the buy right, the anatomy of the target company. And quite simply, I have a principle. I have a 20-20-20 principle, and that is a criteria for evaluating a company. And then the second criteria under the buy right is due diligence. The third is the broker and the listed with a or the seller listed with a broker. The last criteria is a preserving the status quo. So preserving that historical success and preserving that post-acquisition and going forward. And then, so let me write that down. Okay, so again, just to summarize, the first key to success is to buy right, the anatomy of the target company. My 20-20-20 principle, the seller, owner, and listed with a broker, due diligence, and preserving the status quo. Now I go into detail on explaining each one of those. Now the second key is the most important, and it's leader and leadership. And it's the most powerful resource that this leader has, any leader has at their disposal, that they have to, in order to be successful, you have to get this the right way. And that it's a very important, and again, I'm not going to mention any of this, what that is, but part of this is not taking for granted the leaders and leadership that are at the companies. You have to make sure this stuff is happening. And what makes a good leader versus a bad leader, which I learned through my military, and then also just as an employee, as a W-2, and looking around and applying those same things that I learned in the military, what separates a good leader from a bad. And there's only one thing, but I won't go into detail of that. But again, this is very important, and it's just the sole reason why companies are successful. And I know a lot of successful CEOs say they're successful because of the people, but they're the ones that have to get those people to be successful. So it's the leader. It all starts and ends with the leader. So again, these are just some of the things that are under leader and leadership. The most powerful resource. I'm an extremely bad speller, especially when with a spotlight on me, I guess. But anyway, difference between good and bad leader, and what you can't take for granted, what leadership and leaders can't take for granted, what I can't take for granted. Okay, the third key to success is a continuation of the second key, and it's sound business principles. Now, I have a business system, and it's really how to get that second key, and how to do that, and how to do that consistently, starting on a daily basis and getting that consistently. So it's a how to align the organization, what to focus the organization on. So when you align it, what are you aligning it to? And the process to do that, to attain that most powerful resource that every leader has, how to do that the right way. And there's 4 basic value propositions that we all value as customers. You're a customer, I'm a customer somewhere. And there's 4 basic value propositions that we all have at the very basic, and they can go up from there, but there's 4 basic, and we have them in different weights. So that's explained here, and that's under sound business principles. So again, the third key to success is sound business principles. It's organizational. It's aligning organization to, and I go into detail what that to is, how to and what to focus on, how to do it, and how and what to focus on. In the system, the system to do that, and the business system that all companies have. All companies have a business system, whether it's a single entrepreneur or 100,000 employee company or greater. And then, of course, the last are those 4 basic value propositions. Now, I go into more detail, and I will share that with interested investors. So again, that is available, and I have it, but this is the summary of those 3 keys to success. Thank you. Okay, so my name again is Steve Bagnashi. My phone number is 585-303-6068, and my email address is skrbags@gmail.com. So if you have any questions, give me a call or contact me, and we can discuss, and I can answer any questions that you have. Again, it's a $5 million investment, and I look forward to hearing from you.
Any more questions you want to ask?
Closest to getting a car.
And go where?
50 years from now, when you're looking back at your life, don't you want to be able to say you had the guts to get in the car?
If you have any questions, please call me. Thank you.